Okay, welcome back. I wanted to do a video on the current state of the market as of right now and possibility of hyperinflation and kind of what we're seeing with our overprinting of money. It's been happening now for quite a few years. Right. So I wanted to, and I did try to get to Warren Buffett last time with you. And he's number 8 in the world as far as money. He's been around forever. Older guy. He's obviously very, very old. And he's still with it. He's a real sharp guy. So he was known as the Oracle of Omaha, and he's one of the most successful traders of all time. So we kind of wanted to take a look at what he had to say.
Are you seeing signs of inflation beginning to increase?
We're seeing very substantial inflation. It's very interesting. We're raising prices. People are raising prices to us. It's being accepted. I mean, it's not, take home building. I mean, the cost of, we've got 9 home builders, and in addition to our manufactured housing thing, and then operation, which is the largest in the country. So we really do a lot of housing. The costs are just up. Steel costs just every day. They're going up. And there hasn't yet been, because the wage stuff follows. I mean, if the UAW writes a 3-year contract, we got a 3-year contract. But if you're buying steel at General Motors or someplace, you're paying more every day. So it's an economy really, it's red hot. I mean, and we weren't expecting it. I mean, all our companies, when they thought when we're allowed to go back to work, at our various operations, we closed the furniture stores. I mentioned, they were closed for 6 weeks or so on average, and they didn't know what was going to happen when they open. And they can't stop people from buying things, and we can't deliver them. And they say, well, that's okay, because nobody else can deliver them either, and we'll wait for 3 months or something. The sort of the backlog grows, and then we thought it would end when the $600 payments ended, and I think around August of last year. It just kept going, and it keeps going, and it keeps going, and it keeps going. And I get the figures.
All right, so you can hear his attitude towards kind of the state of the economy as of right now. Now, if we look at Warren Buffett's current holdings, he has 40% in cash right now. So he has gone way to cash. But one of the reasons why he does so is, in case of a market crash or a major correction, he has enough cash to buy at the lowest point or near the lowest point. Nobody's going to time the market perfectly, and we all know that. And by the way, this is not financial advice. I am not a stockbroker. This is just informational news. So please take it with a grain of salt, but do your own research. But Warren Buffett's major positions are in Apple and American Express and Bank of America and Co. And these are all, most of these are dividend stocks. Apple's obviously a very strong company itself. Moody's is a financial stock. This is a consumer discretionary stock. There's many different types of stocks, but you can see, and he owns oil. So that's some of the positions that Warren Buffett has. When we look at Warren Buffett's portfolio, like I said, he's gone to a lot of different cash, and he's now surpassed his 28% of his portfolio, and he's up to around 35%. And his critics sometimes argue with him over that because his money's not working for him. But it's not when you sell, it's when you buy. Okay. And another famous quote that he says is that when people are greedy, be fearful, and when people are fearful, be greedy. And let's face it, we've seen a lot of greed in the market over the last couple of years, especially. So he has something called the Buffett indicator that he's had. And this is a great indicator of when markets are going to correct or possibly crash. So let's take a look at what he has currently. His indicator says, and it basically is a ratio of the United States stock market valuation, and the gross domestic product. How much do we actually produce? And right now, the U.S. aggregate market is at 48.1 trillion, and our annualized GDP is at 23.8. So his calculation says it's 57% above the normal average, as stated by interest rates. And this is his indicator. And every time we've seen this, like in 2000, was our last major crash. It came all the way down. And this is our historical timeline of the market's going up. Okay. We saw this get to astronomical levels at like 150%. All right. Also, in around 2008, we also had a market correction. And you can see right here, we also had a slight correction. And this is the March 20th from last year that went all the way down. So we're way above. This is January 20th, 2022, and we're at 202%. So we can't keep printing money without making money. So in the next 5 to 7 weeks, I'm going to go out on a limb and say that the market's going to have at least 20 to 30% correction based on a lot of these different indicators that I keep seeing. Now, again, this is not financial advice. This is just one man's opinion after doing a lot of research. All right, so what are the top sectors that we have if we want to stay in the market during high inflationary times? Obviously, there have been historical winners and losers, and it does differ each time. But what are we seeing right now? We're seeing energy stocks, and that's what I'm heavily weighted on. I kind of indicated that in my last video. So we're seeing the history of inflation over time in some of the different market sectors itself. I mean, we're going to go down here to where we see in sectors. And right here is energy, and this is what happens during high inflationary periods. This is healthcare, okay, which has happened, but it's only happened a few times. And finally, we have utilities. So utilities are very, very stable and very, very predictable during areas of high inflation. Another one is financials. Financials are right here. And although they do terribly at certain points, it has been an indicator that they have the ability to actually increase their interest rates. If we're a bank, you can just increase your interest rates, which does discourage lending, which makes people stop buying things and the price have to come down at some point. So I'm going to be watching really heavily into energy, what I'm going to have left. And I am going to start pulling cash off the table. All right. Here is Warren Buffett one more time. And he's saying the top stocks to own during high inflations in 40 years' time. So this was also in January of this year. And he does mention some of the stocks like American Express and Coca-Cola and Apple. And you can see by his portfolio, it does back those things up. All right, now, I'm going to try to make this as short as possible. These are his stocks, some of the ones that he has, or I'm sorry, these are the top dividend yield stocks. So these are all usually good to be in during times of high inflation because they do pay you a dividend. That means they just return their profits back to their investors. So for instance, let's just go up to here and something easy. Let's just say AbbVie had a 5% yield. Well, it doesn't matter, 4.4. So if you put $1,000 into AbbVie, at the end of the year, you're going to have 1,004.4 shares. So you do get a little bit of return on your investment, which is better than the banks are doing right now. But remember, if AbbVie stock goes down by 5 or 6%, you're going to be losing overall. So that's just an idea of what some people do that are a little bit safer. All right, there's a few other things I wanted to hear him say and have you hear him say, and then I want you to make your own decisions concerning this.
A big way. That will be a new experiment.
So what does all of this mean for the economy today? The S&P 500 is close to hitting 5,000 and the trend line has it running much higher than this. Those that call for a market recession have been proved wrong over and over again for over a decade. Gold bugs and doomsayers have been largely embarrassed, and even Warren Buffett, who has been hesitant to deploy his large treasure chest of cash, has been ridiculed for missing out on these large, massive returns. Predicting when the market will crash, especially in the parabolic environment we are in today, is nearly impossible.
Told you,
Betting
pretty
against the
much
Federal
cash.
Reserve is impossible, but that alone doesn't change the fundamentals. Anyone with a world history book knows the truth. Eventually, printing money out of thin air, increasing the wealth gap, and lowering interest to zero is a recipe for disaster. At the end of the day, this endless routine of kicking the can down the road will end, and the stock market will crash as a result. In 1929, the US market fell over 90% in a period lasting from March 1929 to June 1932.
All right. So you can see what he's saying as far as a disaster. So it can fall up to 90% in certain cases. Now, sure, this has been since 1929, and we've kind of learned our lesson, and we do employ people like Jay Powell, who's the head of the SEC, to navigate this for us. But it doesn't always work out the way they say. And they're always behind. I watch some professionals and also El Ron, this stockbroker for J&P. He says that, and it's true, that when the SEC or the Fed makes moves, they're making it after they should have. This is one of my favorite guys. His name's Kevin. He ran for governor in our California, and he's worth a ton of money, and he does stock videos every day. And let's listen to what he's personally doing as of right now, this second. This was made January 22nd, 2022.
Number one, for most passive investors into index funds, in my opinion, the best answer here is probably, and not financial advice for any of this, obviously, but hodl and just buy the dip. Dollar cost average your income, cut spending, increase your contribution to the market. Again, dollar cost average, and now could potentially be a time to do that. A second path could be selling to go to cash as a hedge. So there's path 2A, sell and go to cash as a hedge. Path 2B could be hodl but buy weekly puts as a way to hedge. Path 2 is all about hedging. Or path 2C, you could sell just enough to eliminate your margin. And then path 3 is do nothing. So you have these three overall paths. One, just DCA, keep buying the dip. Path 2 is hedge, and path 3 is do nothing. Path 2 is more of a trader mentality, right? And quite frankly, sometimes doing nothing is best, which is path 3. Sometimes continuing to dollar cost average is also best. It's the passive way to invest.
Really good
easiest thing
advice
to do. I think it's the wisest thing to
have
do.
right now.
Now, in this case, though, I personally have chosen to trade these market catalysts. Now, I could be entirely wrong. I hope I am. I hope we're at peak fear and we've hit the bottom of the market and, we rally like crazy. I don't really think markets can rally on anything other than January 25th and March 16th going substantially better than we believe, as I've described, how the market tends to historically react. Now, I've sold 99.15% of my stocks and my entire crypto portfolio. Of the cash that I have right now, I am 5.56% short the market. So of the cash I have, I'm 5.5% short the market with a put option on the market. And it's a short-term one. So I want to be completely.
All right. So what does he actually say? He sold everything. Now, that's really very, very aggressive. It may not be, it's not the situation that I'm employing. I may sell 30% and 30 to 40% and put that into cash. While most of my other investments are in oil, energy, and financials, and some of the pharmaceutical companies that seem to also do well in hyperinflationary. But he did say that he was shorting the market, and that means when you short the market and you buy puts, you're predicting the market is going to go down. And the further it goes down, the more money you make. And so you probably heard that term before about people shorting the market, making a lot of money. I also did some investigating in the shorts on the S&P 500 by hedge funds has been increasing rapidly since January began. Again, this is not financial advice, but I'm looking at a huge market correction. Corrections are between 10 and 20%. Crashes can be up to 50 or 60%. I'm thinking at least maybe 30 to 40%, and possibly within the next 6 weeks. That March deadline with the SEC, we have one coming up next week, so it'll be very interesting in earnings. But towards that end of February, early March is where I'm thinking depending on the pivot of the SEC and rate hikes and during hyperinflation, this is not going to be a good year. Now, towards the end of the year, I have a feeling we will recover. But the whole key to this is having enough cash to buy low. You want to buy when everything is low, and then sell when it's spring again. All right, hope this has been informative for you. Hope you take this with a grain of salt, although I just thought I'd deploy and tell you exactly what I'm doing, and quite a few other people that I've seen that are in the business that have a hell of a lot more money than I do and a lot smarter than I am. As always, God bless and have a great evening.